This is Wall Street Week. I'm David Westin. We're going to conclude our week, as we always do, with our special contributor here on Wall Street Week. He is Larry Summers of Harvard. So, Larry, thank you so much for being back with us. Let's start with the jobs numbers. Came out on Friday this week. Disappointing by quite a margin, I must say, although some people thought underlying it, the numbers weren't as bad as maybe they appeared.
David, look, I think this fit the story that we've been telling on this show almost exactly. We got a lot of demand. We don't have so much supply. That's why the unemployment rate came down more than people expected. That's why the wage growth was much higher than people expected. We don't have a soft economy in terms of demand. We have more damage to people's willingness to work than people expected a few months ago. The problem is that this points in favor of the inflationary diagnosis. Look, average hourly earnings this month, rose at a 7.5% annual rate. That's not consistent with any reasonable theory of inflation. And with the unemployment rate lower and falling, the situation may even get worse. So I think we're in a very difficult situation. Here's one way to think about it. We've got interest rates way below their neutral level. The Fed thinks the neutral level of interest rates like 2.25%. They've got interest rates close to 2.5%. They've got interest rates close to zero. And I think given the vast structural changes underway after COVID, we've probably got unemployment below the natural or neutral rate of unemployment. And that's just not a combination that adds up to anything other than taking a big risk on the inflation side. So I'm pretty concerned about where we are.
So actually, I talked to Steven Mnuchin, who held the Treasury job that you held. He held it under President Trump this week, and he said he's very concerned about inflation. He thinks we're going to 3.5 in the 10-year. I know you're reluctant to call specific names in the 10-year, but do you disagree with Steven?
Look, you never know which way markets are going to move next, but I certainly see more pressures on the upside for the 10-year bond yield than I do on the downside. And I certainly think that markets are not fully pricing in the risks of a tail event where the rate goes up pretty fast.
So I want to turn to a different subject, something you wrote on in the Washington Post at the end of the week. And it's this proposal, actually, as part of the Biden package, economic package, that the banks report to the IRS on the overall inflows and outflows, as I understand it, of deposits being held, basically as a way to get at some income that otherwise doesn't show up, for example, on your W-2 or your 1099. You wrote, and you were pretty forceful about it, I must say, in the Washington Post. Explain your point of view on this.
David, I think this is really an easy one. Right now, if you or I have an account in a bank, the bank reports on that account by reporting interest. So we're already sharing that information with the government, and the IRS is already learning about our bank account. The proposal that's made is that in addition to reporting on the interest they pay, they report on the inflow when the money comes in. And the reason for that report is that we've got an epidemic of tax non-payment in this country. On income that you get in a wage or a salary on a W-2, compliance is above 99%. On income where you don't have information reporting by businesses, it's below 50-50. And in total, the tax gap is going to cost us $7 trillion over the next 10 years. So the proposal is that when banks get substantial deposits, they have to report them. There's plenty of room for argument about exempting the little guy. There's plenty of room for argument about how if it's a paycheck, it's already being reported on, so you shouldn't have to report it again. Those are details that can be worked out. But when the banking industry is saying that this is some kind of major invasion of people's privacy. This is something that's impossible to do. I mean, these are people who are like incredibly proud of the fact that they're letting you buy a fraction of a stock on your cell phone in 2.5 seconds. The idea that it's some kind of big burden to report a basic inflow to the IRS on an account where you already report is absurd. And, I think the banking industry is right in some of the concerns it's had at some points about being demonized. But, God, you got to play it both ways. And this is a pretty elementary thing in the interests of the country. And I've really been pretty disgusted, I have to say, by what some of the bank trade associations have been doing in terms of demagoguing this. It's not mostly the biggest financial institutions, it's the trade associations, and I guess their Washington representatives have to do things to get people excited to justify their existence. But I've seen a lot that's not too appealing, and this is pretty close to a new low.
So Larry, speculate with me. You know these banks terribly well. What's driving them? If it's not the administrative burden, you sort of dismiss that. If it's not the privacy concerns, why are they protesting so strongly?
Some of it is probably that they want to maintain good relations with their customers who aren't always honest about the tax law and don't want to be reported on. When you see a business do an unreasonable thing, it's often because they're in service of their customers. That's one possibility. Another possibility is that they're people who just don't like taxes and don't like anything about taxes. Look, I think in fairness, the IRS has had some privacy problems. Some of these revelations that have been so shocking have also been wrong. And I think that contributes to this ethos. But I sure think that the thing everybody ought to be able to agree on, Democratic and Republican, whatever exactly you think, $7 trillion over the next decade in taxes that are legally owed under the tax law legislated by Donald Trump and not paid, that's got to be a scandal that calls for us to do much more than we're doing. And information reporting is one part of that, and strengthening the IRS is another.
So Larry, finally, give us a thought or two about the IMF World Bank meetings coming up next week, actually. Look forward to next week. What are the big issues that you think will be on the agenda? What should be on the agenda?
We are sleepwalking towards doom on climate change. We are sleepwalking towards doom on pandemic preparation. And people are writing communiques about agreeing to cooperate and forming working groups and engaging in business as usual. It's not business as usual for viruses. It's not business as usual for forest fires. It's not business as usual for rising sea levels. And it shouldn't be business as usual in terms of the global financial response. What we are seeing is, in terms of its significance, the global equivalent of the 9/11 attacks, much greater in terms of the number of people who will suffer. And what we are seeing is not a roaring mobilization, but a thin, pale bit of bureaucracy.
I want to sneak in one more.
That should change.
One of the things
I don't think it will, but I hope it will. I hope it does.
Okay, fair enough. One more I want to sneak in. That's the debt ceiling deal that was done this week, kicking the can down the road till December 3, frankly. We've talked about it a lot. You were concerned. We dodged that bullet. Are we in any better shape today than when we were before that deal was done?
Yes, I think we are. I think we are, David, because I think, first of all, we've averted a catastrophe. Second of all, we're going to be able to work through whatever it is that's going to happen on the budget on a time frame that's different than the debt limit time frame. So we'll have more clarity, and I think that'll make it easier to deal with the debt limit in December. So are we out of the woods? We're not out of the woods, but are we any longer in the center of the dark forest? No, I think we've moved towards the edge.
Larry, one of the big developments potentially this week had to do with that global minimum corporate tax. Ireland surprised, at least me, by saying, yes, we'll go along with it. And now we know, in fact, it will go forward. Tell us about the significance of that, potentially.
David, I think this is the most important global economic agreement of the 21st century so far. It's important in reality because it's going to fortify tax collections from corporations for companies all over the world. It's important in principle because instead of countries running a race to the bottom with respect to taxing business income, they're now going to level up in a way that's going to be fairer and permit tax reductions on working people all over the world. And it's important in showing that global economic diplomacy can be something that's not just about the people who are in Davos, but about working people everywhere. Joe Biden's talked about a middle-class-based foreign policy. This is a huge triumph for that. It's a great credit to the president who created the environment, to Secretary Yellen who drove the agreement, and to a large number of officials who've been working in this area for many, many years. This is really a big deal for international economic diplomacy.